Money talks, but do you speak its language? Welcome to Finolux, where we break down finance so you can build up your future. Budgeting. Creating a plan for how you'll spend your money each month based on your income and fixed expenses. It helps you avoid overspending and stay on track with financial goals. Saving. Setting aside part of your income regularly to build financial security, cover unexpected costs, or save for big goals like a home or retirement. Emergency fund. A dedicated savings fund, usually 3 to 6 months of expenses, meant to cover sudden financial emergencies like job loss or medical bills without going into debt. Credit score. A number between 300 to 850 that lenders use to determine how likely you are to repay debt. It's based on your payment history, amounts owed, credit length, and more. Debt. Money that you borrow and are obligated to pay back with interest. This includes credit card debt, student loans, mortgages, and personal loans. Interest rate. The percentage charged by lenders or earned on savings and investments. It's the cost of borrowing money or the reward for saving, investing it. Compound interest. Interest that is calculated on both the original amount and the accumulated interest from previous periods, essentially earning interest on interest. APR, annual percentage rate. The yearly cost of borrowing money, including interest and fees, expressed as a percentage. It's useful when comparing different loan or credit offers. Net worth. A snapshot of what you own, assets, minus what you owe, liabilities. It's a key indicator of your overall financial health. Checking versus savings account. A checking account is for frequent transactions, bills, spending, while a savings account is for storing money and earning a bit of interest over time. Income versus expenses. Understanding how much money you earn versus how much you spend helps you see if you're living within your means or heading toward debt. Taxes, federal, state. In the U.S., federal and state governments tax your income. How much you owe depends on your earnings, filing status, and deductions. (401k). A retirement savings plan sponsored by an employer. Contributions are pre-tax, grow tax-deferred, and many employers offer matching contributions. IRA, traditional versus Roth. Retirement accounts that offer tax advantages. Traditional IRA offers tax-deductible contributions, while Roth IRA allows tax-free withdrawals in retirement. Inflation. The rise in prices over time that reduces your money's purchasing power. It means your dollar buys less next year than it does today. Capital gains. The profit you make when you sell an asset, like stocks, property, or crypto, for more than you paid for it. If you held the asset for over a year, it's a long-term gain, usually taxed lower. Under a year, it's short-term, taxed like regular income. Tax-deferred account. An investment account, like a 401k or traditional IRA, where you don't pay taxes on the money until you withdraw it later, often in retirement. This helps your investments grow faster in the short term. Taxable account. A regular investment account where you pay taxes on dividends, interest, and any capital gains you realize each year. Offers more flexibility than retirement accounts but with fewer tax advantages. Roth IRA. A retirement account where you pay taxes upfront when you contribute, but then your money grows tax-free, and you can withdraw it tax-free in retirement. It's great if you expect to be in a higher tax bracket later. Risk tolerance. How much risk, losses or volatility you're emotionally and financially comfortable taking with your investments. Affects whether you choose stocks, bonds, or safer options like savings accounts. Index fund. A type of investment that tracks a market index like the S&P 500. Instead of trying to pick winning stocks, you own a little piece of many. It's low cost and considered a smart way to grow wealth long-term. ETF, Exchange Traded Fund. A fund that's traded like a stock but holds many different investments inside. ETFs often follow an index and offer diversification, low fees, and flexibility for investors. Dollar cost averaging, DCA. An investment strategy where you invest a fixed amount of money at regular intervals, regardless of the market price. Helps reduce the impact of market volatility over time. Options and derivatives. Financial instruments whose value is derived from an underlying asset, like stocks, commodities, or indexes. Common derivatives include options, futures, and swaps. They are used for hedging or speculation and can be highly complex. Short selling. A strategy where an investor borrows shares and sells them with the intention of buying them back later at a lower price. If the stock price drops, the investor profits. It's risky because losses can be unlimited if the price rises. Hedging. A risk management strategy used to offset potential losses in one investment by making another investment. Think of it as insurance for your portfolio, using tools like options, futures, or diversification. Private equity. Investments made in private companies or public companies that are taken private. Investors typically aim to improve operations and eventually sell the company at a profit. It often involves large capital and long time horizons. Venture capital. A type of private equity focused on investing in startups and small businesses with high growth potential. Investors provide capital in exchange for equity and take on high risk for potentially high reward. Capital structure. The mix of debt and equity that a company uses to finance its operations and growth. A company's capital structure affects its risk, return, and financial health. Mergers and acquisitions, M&A. The process where one company purchases or combines with another. M&A activity is driven by the desire for growth, diversification, or competitive advantages and involves complex financial, legal, and strategic planning. Discounted cash flow, DCF. A valuation method used to estimate the value of an investment based on its expected future cash flows, which are adjusted, discounted, to present value using a required rate of return. Leveraged buyout, LBO. An acquisition of a company using mostly borrowed money, debt, to meet the purchase cost. The assets of the company being acquired are often used as collateral for the loans. Quantitative easing, QE. A monetary policy where a central bank buys long-term securities to increase the money supply and encourage lending and investment. Used during economic downturns to stimulate the economy. Thanks for watching. Now you speak the language of money. Let's keep building. This is Finolux.